News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug, Brice, and Garrett, helping you retire the job and keep that paycheck. In the studio this morning, you've got Brice, Payne, and Garrett Ray. And today we were talking about 6 topics that retirees tend to misunderstand regarding retirement planning. How you doing, Brice?
I'm doing all right on a beautiful fall weekend, football weekend. Loving it. Broncos are doing solid, though they a little bit of a challenge with an 0-5 Jets there last week, but they managed a W. How are you doing?
Doing okay. Panthers pulled off a surprise. Surprise one last week.
That was a good one too.
So hopefully they keep the momentum going this week. But yeah, it was definitely a good week last week. We'll see if we can go get another victory this week.
Get another one, yeah. Let's start lining those W's up.
That's right.
All right. Well, as everyone out there knows, unless this is your first time listening to the Wealth Guardians, we take a moment at the beginning of every show just to acknowledge our gratitude and want to thank everyone out there who is a first responder and or puts on one of those military uniforms. Oftentimes a thankless job, or at least underappreciated job, and it is a hard one at times. And it's not just hard on those who put on the uniform, but it's hard on the families as well. And we just want to take a moment, as we do every weekend morning here at the start of the show, and just acknowledge and say thank you to everybody out there who does that. We appreciate you. You're in our minds and our hearts. And Garrett, you and your dad, Doug, were served in the Navy, so thank you as well.
All right.
And so another thing that we do at the start of every show before we get into the real topic is we take a moment and we call it the Better Get to Know Your Wealth Guardians Advisor, and just share a little fact about ourselves. We ask ourselves a question so that you might be able to relate to us a little better than just being a voice on the radio. And the question I thought we would ask ourselves today, Garrett, I'll throw it out to you here. Garrett, have you ever met or had an interaction with a celebrity?
I guess it depends on your definition of a celebrity. Some of the listeners know that in a previous life, I have an engineering degree. I worked for Tesla, so that certainly had several meetings with Elon before. On one occasion, I do remember, this is back, again, several years. This is like 2017, 2018 when I worked there. He was dating the actress Amber Heard, famously married to Johnny Depp at one point. And I got to meet Amber, and it was actually my job that particular day to escort Amber around one of the production factories and explain to her the engineering and production process of how Tesla makes their battery packs for their vehicles. So that was an interesting evening.
Yeah, very good. All right. Well, I've had a couple, but the one I'll mention is when I was 2 years old, there was an actress, and for anybody younger than 50, 55, they probably don't recognize this name. Debbie Reynolds was an actress, and she had a daughter, and apparently my mom was at a restaurant and I was at a restaurant, and sitting at the table next to us was Debbie Reynolds and her daughter. And the daughter was about 14, 15 years old at the time. And my being a cute little 2-year-old, the daughter picked me up and held me for a little bit. And Garrett, do you know who Debbie Reynolds' daughter is?
I do not.
An actress named Carrie Fisher. Does that name ring a bell?
Yeah, for sure. Yeah, okay.
Princess Leia.
Yeah.
Princess Leia. I was held in Princess Leia's arms
there you go.
When I was 2 years old. So that was my first interaction with a celebrity. Yeah, so that's mine.
Okay.
All right. Well, there you go. Let's go ahead now and get into this list. As you all know out there, I like to create lists. And this is 6 things retirees tend to misunderstand when it comes to retirement planning. And Garrett, what's the first one that we have on this list?
Yeah, this is interesting, but occasionally we run into this sometimes, Brice, where when people, obviously one of our jobs as financial planners is to map out the income or the cash flow into any household, and that can be either during someone's working years or even after their retirement years. They've already retired. And occasionally we'll run into just a general misunderstanding of how the income tax system works here in America. If you fall into a particular tax bracket, let's say you fall into the 24% tax bracket, you can be misguided to believe that all of your income is taxed at that 24%. That is not the case. We have a tiered income tax bracket system so that as you accumulate money throughout the year, different levels or different tranches of your income are taxed at different rates up to that highest bracket.
Right.
It's just common when you're talking to your CPA or certainly your financial planner to understand, okay, at your highest level of income, what is that highest level of tax that you could be subject to? The reality is the majority of your earnings, assuming you haven't pegged out the tax brackets, meaning you're a super high income earner, the majority of your earnings are taxed at likely lower levels than your highest bracket. So, understanding kind of how that works, and I know we've got some figures up here just to run by the listeners, but just understand that as you earn income throughout the year, you're taxed at a lower rate, and it gets progressively higher as you earn more.
Right. So an easy example is the 12% tax bracket. The next tax bracket up is 22%. So that's a hefty little jump there from 12 to 22.
Yeah, that's the biggest one.
And for the married couple, married filing jointly, that 12% tax bracket stops at $96,950. So if you made $96,951, well, you're technically in the 22% tax bracket.
Yeah.
But how much of that $96,951 was taxed at 22%? $1.
$1.
Yeah. So don't think, oh my gosh, I made $1 too much. Now I pay 22% in taxes rather than 12%. No.
Yeah.
And really that brings up the whole idea of the effective tax rate. That is what's a more important number for you to be aware of than what bracket you technically fall into. So if you were married filing jointly and you had $96,951 of income technically falling into the 22% tax bracket, it would likely be that your effective tax rate was probably closer to around 6, 7, 8%.
Right.
Because you've got the standard deduction. That's the first $30,000 or so, which is taxed at 0. And then the next little tranche, around $23,000, is taxed at 10%. So you have to weight all of that up. And so that's one thing that now some people get that when they come down and sit down with the wealth guardians and they're looking for some financial planning advice. A lot of the people get that. They understand that. But there are a lot of people, when we mention that they had no idea. They've been paying taxes for 50 years of their life, and they had no idea that's how it worked. Right. So when we're creating this list of things that people misunderstand when it comes to retirement planning, that's kind of a big one there. And it's, even though only 50% of the people misunderstand that, it's a big one to misunderstand. So we just wanted to kind of set the record straight there. If you were of that understanding, well, now you know. All right.
Absolutely.
All right. Well, if you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray, and in the studio this morning is Garrett Ray and Brice Payne, and we are going over 6 things retirees misunderstand when it comes to retirement planning. Now, the next one that we're going to get to is Social Security, and there is a concept out there or rule out there. In very easy layman's terms, it is that you can get 50% of your spouse's Social Security if yours is lower.
Yeah.
So let's imagine this. Let's say that you're the husband, and the benefit that you're receiving is $4,000, but your wife's Social Security that she would be receiving is $1,000.
Right.
Well, a lot of people think, well, I the husband, I'm getting $4,000. My wife is entitled to getting the amount that is equivalent of half of mine, which is therefore $2,000. So she doesn't get $1,000, she gets $2,000. Now, that is somewhat true.
Yeah, it can be true.
It can be true, but here's the thing. If the husband's benefit that he is receiving is $4,000, that is not what the spouse is entitled to. They are entitled to half of what the husband or the wife, if you want to reverse the rules, half of what their full retirement age benefit is. Right. That is not necessarily the benefit that he is receiving. If he filed at age 70, well, his full retirement age benefit at 67 would have been significantly less than $4,000. We'll call it $3,000.
Right.
So if he didn't file until full retirement age or later, and she doesn't file until her full retirement age, she would be entitled to half of that full retirement age benefit $3,000 in this case. So she would be able to get $1,500. And a lot of people misunderstand that. They think, well, wait a minute, my wife is entitled to half of what I'm getting. Yeah. I'm getting $4,000. And so there are some things that will even lessen it from the full retirement age. For example, if the husband didn't filed earlier than his full retirement age, that's going to knock some percentage points off of what the spouse can get. And if the spouse is trying to file for their spouse's benefit earlier than their full retirement age, that as well can knock it down a little bit. So that is the misconception right there is you're entitled to half of what the spouse's full retirement age benefit is under some circumstances.
Right. Yeah. And it involves both spouses in this case.
Exactly.
And their respective ages. That's the critical calculation there, is understanding when both spouses file and the ages in which they do.
Yes.
Then you can be eligible for up to half.
Right. Now, we are certified with the National Social Security Association, and we are because that is an important thing to understand is the rules and the ins and outs of Social Security, because it is a main cornerstone of income for probably a majority of families in the United States, and understanding what your benefits are, the different ways that you can file. A lot of people, for whatever reason, think, well, I'm going to file for Social Security the day that I retire. That's the way it's supposed to work. Well, that's one way to file, but that is not necessarily the most advantageous way for any household to file. So you really want somebody who is knowledgeable about how Social Security really works to help you figure out what is the most sensible way for you and your household to file. Well, that's 2 of the 6, so we've got to get to the other 4 here, but we do also have a break that we've got to get to. So what do we do, Garrett, before the break?
I bet you have a trivia question now, Brice.
I've got a trivia question. And for the last couple of years, I've been focusing these trivia questions around history. And I think I might change that theme up to trivia questions around the United States. And so here we go. Here's our trivia question. Garrett, are you ready?
I hope I'm ready.
Who are the only 2 non-U.S. presidents to have appeared on U.S. currency? And currency meaning bills.
Ooh. Wow.
Who are the only 2 non-U.S. presidents to have appeared on U.S. currency? Okay, well, stick around for the answer to that trivia question and see if we stumped Garrett on the other side of this quick break. This is Brice Payne. With me is Garrett Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM, WTOB. Welcome back to the Wealth Guardian Show, where we help you retire the job while keeping the paycheck. I'm Brice Payne in the Wealth Guardian studio, along with Garrett Ray. And in the second segment, we're going to continue our discussion on 6 things retirees misunderstand when it comes to retirement planning. Now, before we answer that trivia question that we left you hanging with at the end of our last segment, I want to ask you this as well. Are you planning to retire? Okay, I'm guessing the answer there was yes. My follow-up question would be, have you met yet with a retirement income certified professional who is also a fiduciary? If you have not, I'm going to invite you to take us up on a complimentary review of your current situation. Complimentary means no cost, no obligation. As certified retirement planning specialists, we put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security filing, and tax efficiency, with often adding the additional benefit of reducing both the risk and fees of your current plan. So if you've put aside at least $400,000 and you want to take us up on this no cost, no obligation review, here's how you get a hold of us. You can pick up the phone and dial these numbers in this order: 336-391-3409. That's 336-391-3409. Or you can go to thewealthguardians.com to learn more. Let us show you in black and white how to retire the job and keep the paycheck. All right. The trivia question. We're starting a new theme here, moving away from dates. Your dad really hated date questions, Garrett. I'd start them off in 1492. He's like, come on now. So we have no excuse of not knowing certain things about our country. And here's the first question in this new theme. Who are the only 2 non-U.S. presidents to have appeared on U.S. currency? And Garrett, what say you? Who are those 2 people?
Yeah, well, I'm definitely going to get this one wrong. I think I only know one. And I want to say that wasn't Sacagawea on one of the coins.
Right, but that's why I clarified that currency meaning paper bills.
Of the bill. Well, then I got it completely wrong then. So I knew about Sacagawea.
Sacagawea was one. Susan B. Anthony appeared on a coin as well.
Yeah, she did. Okay.
So that's why we're talking about currency.
Okay, no, I don't know any of the bills then.
Oh, you don't?
No.
Oh.
I completely got this wrong.
Oh, okay. Well, Benjamin Franklin.
Okay. Yeah. The founding father. Yeah.
Yeah, he's a founding father. Exactly. He was never president. What bill does he appear on?
100, yeah.
The hundreds. All right. And the other one, Alexander Hamilton. A lot of people think, well, surely, I don't know all my presidents, but surely Alexander Hamilton was a president. Yeah. No, he was the first Treasury Secretary, and he appears on the $10 bill. Never was a president. So those are your only two non-U.S. presidents to appear on paper currency. Yeah. So there you go. If you got that out there, congratulations, because that was a little bit of a tricky one when you think, well, these are famous people. Certainly they were presidents. No, they were not.
I fell into that bucket.
Those two cases.
I'm guilty as charged.
All right. Well, let's move on to our list here. And again, these are 6 things retirees misunderstand when it comes to retirement plan. Hopefully we'll get to all 6 here. The third one is IRA/Roth is not the investment. Well, what do we mean by that? Garrett, take this one away.
Yeah, it doesn't happen often, but occasionally we'll get a question that sounds something like this. Brice, Garrett, what are IRAs getting these days? Or what are the rates on Roths?
Is it what's a better investment right now, an IRA or a Roth?
Right, something to that effect. And it's basically the designation of an account and how it is taxed that differentiates between a traditional IRA and a Roth, or a traditional 401k, any employer plan and a Roth plan. It is not necessarily what is inside of the account and what that account is invested in. That line of questioning that we get sometimes tends to kind of be a line of questioning that you would get about like rates on CDs, or perhaps yields on certain issuances of bonds. What is the 10-year getting these days as far as yield? You could understand that line of questioning. An IRA or a Roth, or even a traditional 401k to some degree, typically you have multiple different investment choices in there. Certainly you do inside of a traditional IRA and a Roth. You basically have the entire market available to you. You can trade options inside of those things. You can do a lot of
precious metals, real estate.
Yeah. So to say
options.
What is a better investment, an IRA or a Roth, or what is an IRA getting these days? It's more of you're misunderstanding how the accounts are designated. Inside of a traditional IRA, the deal is that for any contributions you put into the IRA, you can then take a tax deduction in the year of the contribution. The promise being that you will pay taxes when you take that money out as a distribution later in life, and you will pay them as income taxes. A Roth, you basically don't get a deduction when you make the contribution. You pay the tax rate at whatever you are in the year of the contribution, with the promise that you will be able to let those accounts grow and take them out tax-free upon use. So that's the difference. And basically, when you ask that line of questioning to Brice, myself, or Doug, then we start kind of putting on our tax hat and say, okay, let's look at this family from a tax perspective. What's their income situation now? What is it likely to be a year, 5 years from now? And that might help sway our decision about, is a traditional IRA versus a Roth, and what's the right mix? Right.
The way I paint the picture for people is, let's imagine 2 shoe boxes here. We write IRA on the top of one shoebox, and we write Roth on the other. You put $100,000 into both of those. That $100,000 is now going to be taxed differently in each of those, but the investment inside, you could take that $100,000 and invest it in mutual funds, stocks, bonds, almost whatever you want. So it's a separation of concepts of the registration or the designation of the account versus what is the actual investment inside that shoebox.
Yeah.
And so when somebody asks us that question, what are IRAs getting these days, that shows that we need to just put our teacher hat on for a second and explain the difference between that.
Yeah.
All right. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray, and we are continuing our conversation on 6 things retirees misunderstand. So far, we've gotten to 3 of these, and let's see if we can get to another 1 or 2 here. Garrett, the 4th one is precious metals are not a growth instrument. That is going to surprise people because you looked it up before the show. What has gold done here in the last recent period of time?
Yeah, so if you go back a year from October of last year, gold is up 53%.
Holy cow. Well, then it has to be a growth vehicle, Garrett. It absolutely has to be.
Has to be, right? No, it's a gold is like, the way that we look at it is if you really want some gold as a diversifier in your investments, that's fine. Just understand that it is an investment like anything else, and that price tends to move. So, Brice, his question made me do a little bit of research. I like doing research. And, if we look up the ticker symbol GLD, right, that roughly tracks the spot price of gold. GLD, if you go back to 2012, was sitting at 164 per share. Okay. And it took all the way until December of 2022 for it to get back to $162 a share. It basically had a lost decade. Now, to be fair to gold, it's stabilized right around $115 per share for that entire decade. Mm-hmm. So was gold a stabilizer to that portfolio during that decade? Yes, it was. But you would be very disappointed if you bought that share of GLD thinking it was going to be a growth investment.
Right.
So it is an investment just like anything else. You have to track the price. You have to understand what you're buying. And yes, currently, today, if we look at the 1-year performance of gold up 53%, that certainly classifies as high growth levels. But to think that gold is in that position at all times would be false. From 2012 down to 2016, GLD was actually a net loser. So you have to define your time horizon when you're talking about gold and what the price is doing. It can gain and lose just like any investment can.
Right. So. If you're an active trader and you're constantly checking in on your investments and prepared to buy or sell at any given point, there can be a lot of money to be made on precious metals because it is a volatile instrument, but you would have to be constantly, I don't want to say constantly, but you would have to be frequently buying and selling to really be making money. And that's fine. Great. If that's what you do and that's what you want to do and you're prepared to put that time and that energy aside, then great. Yes, you can make money off of gold. But if you bought gold 20 years ago and you're sitting on it thinking this is going to grow better than the S&P does or better than my stocks do, under most decades, you're going to be disappointed in that because that's not what it's designed to do. It is designed to be a hedge against inflation. And you've done the research too, Garrett. We did a podcast on this some time back. But if you pull back and look at the 50-year price of gold, it tracked a little bit better than inflation itself.
Yeah,
a little bit better. Yeah. So that's what it's for. It is not a growth vehicle, even though you can make money on it, but it takes a lot of time and energy on your part to do it. It's not a buy and hold growth vehicle. All right, we've got time for one more here, and what we're doing is number 5. In-service rollovers are a thing. That's something that a lot of people misunderstand about retirement planning. They don't even know what an in-service rollover is. So it's a type of rollover. Garrett, what is an in-service rollover, if you will, quickly? Yeah,
an in-service rollover essentially is a special case that is available for employees who are age 59 and a half or older. And basically what it says is that the entire purpose of 401ks, 403bs is to one day save up for retirement. That's the entire purpose of it. That's why it's a benefit for you. When you turn 59 and a half or older, your employer allows you,
in most cases,
not always, but in most cases, to roll over a portion of that money that's in the 401k to an IRA or a Roth outside of your employer plan to start preparing for retirement and do some advanced planning around, but still remain inside the 401k as an employee making active contributions to it with every paycheck you get, be that, every 2 weeks, monthly, however you get paid. So you basically get the benefit of maintaining the contributions in the 401k and being able to roll that money outside into an IRA for some additional planning.
Yeah, this was a rule that changed about 17 years ago after the financial crisis. Before that, you weren't able to touch your 401k until you left the company, regardless of what age you were. Well, they changed that. If you're 59 and a half, you can now roll over your current balance or a portion of your current balance in most cases to an IRA. And as Garrett said, your contributions remain unaffected. But the reason that is because your 401k is highly limited in how many investment options are available in there. So that is something. 59 and a half is the magic year. If you are of that age and you're not completely happy with your investment options inside your 401k, that would be a time to go to a financial planner and talk about your options you have to you. And we are financial planners. Well, what a coincidence. And our phone number is 336-391-3409. If you'd like to sit down with us and you are 59 and a half or approaching there, then we would be happy to help you out and see if the ISR, the in-service rollover, it makes sense for you. But we are out of time, unfortunately, and we do want to thank you for joining us. We hope the rest of your weekend is everything you want it to be. This is Brice Payne, along with Garrett Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And I'm here to remind you, sound financial plans do not create themselves. This is News Talk 94.5, WPTI. This is 96.7 FM, WTOB.
Hi, it's Garrett Ray with The Wealth Guardians. Thanks so much for listening to the show. Make sure to check out our weekly series, The Vault, on YouTube. Find our channel, The Wealth Guardians, where we talk about all things retirement planning and cover new topics each week, such as Social Security, tax planning in retirement, and our thoughts on investment best practices, and much more. New episodes air Thursdays at 2 p.m. Make sure to subscribe to the channel so you can get notifications when we release new episodes. We're here to help you retire the job and keep that paycheck. We'll talk soon.